Hello everyone, welcome. It's Wednesday, 11th of May. So actually, we are in the spotlight of the week. I mean, the day, Wednesday is the spotlight of the week due to the inflation. As you already know, the markets are well expecting the U.S. inflation to come out. It might be the most important data released since Fed is out, NFP is out, and etc. So markets are really wait and see on the what will happen with the inflation, and this will, in my change the expectations for the Fed next actions. But yeah, that's just for your own information. So today we're gonna have a webinar based on the VIX, on the Volatility Index, what it is, a bit of a background, why it's useful, how it can be traded, and what it signals. So this is our the topic of the day. So I have already uploaded the handout. It's my slides in the PDF format as usual. And yeah, that's pretty much it from me. I will go through the disclaimer warning, but please, until I read out loud the disclaimer warning, I will really appreciate if someone let me know in regards to the audio, and also whether you can see my screen as well, just for confirmation. So just a quick yes or a no, and etc. And I will just to make sure that everything functions properly. Thank you, Lebalo. Thank you very much. So disclaimer. These materials provide general market communication for informational purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instruments. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. User knowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk, for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, take into account your investment objectives and level of experience before trading. And if necessary, seek independent advice. So you can find our full risk disclosure along with all the legal documentation that you might want to see in our website. Okay, so feel free to have a look on the website www.hfm.com. As you already know, a new era has started for us. Hot Forex evolved into HFM. Nothing really changed. We remain as we remain at your disposal, trying to provide the best service for our clients with honesty and transparency as usual. We just did this change in order to be able to expand and to provide even more products, except from the CFDs, of course, but to provide more, such as the physical stocks and etc. So yeah. So I'm very good, dear Shaik. Thank you very much. How are you? Glad to see you here. So any problem as usual, please either stick it in the box, or any question, anything you want to ask, just stick it in the box, or send us an email at webinars@hfm.com. Sorry, it's hfm.com. It has changed. That's why I put in a capital, webinars@hfm.com. It's me, Stuart, and the support team that replied to that email. So we reply in 24 less than within the day. I mean, less than 24 hours. So that's. Let's move on. Yep, let's move on again. As I can see, there the people that they have joined today's webinar knows me. There are people that have attended before, so there's no need to introduce myself once again. And let's move on to our topic. I am doing well, thank you. I was waiting for this webinar because I've been trading the S&P a lot lately. So you already know how the correlation there, Shaik, between VIX and S&P 500. So yeah, this is what we're gonna go through. The strongest correlation is S&P 500, but it doesn't mean that is the only correlation, by the way. Yeah, but it's a very, very good indicator, VIX, Volatility Index, for USA 500 and in general the equity market, the US equity market, but the global equity market in general, because it clearly presents the expectations that the market have. So yeah, this is what we're going to cover today. What the volatility index is, why and how to trade the VIX, what signals it gives, and of course we could move on with any questions that you have. We'll try to reply to as much as I can. So trading the volatility index. Actually, Shaik, since you mentioned it, are you using VIX for your trading in USA 500, in S&P 500, or for equities? Are you using it as an indicator, the performance on VIX as an indicator? Just out of curiosity. Okay, until Shaik replies, I will start. Let's have a look. Okay, here we are. No, I haven't used it before. Okay, that's why you're here. Okay, great. Okay. We'll start a bit with the basics, okay? First of all, let's see what it is. By the way, because I have the theory first, what it is and etc. I would like to show you, first of all, the chart, because I haven't. This is the VIX future, the volatility index future in our MT4. You can find it in MT5 as well if you are using MT5, but it's just another asset, okay? Just another index, okay? But why is important? And let's see together why it's important. Let's scan through the theory of it, what it is. So VIX, volatility index otherwise, it's actually an index, okay, created by the Chicago Board Option Exchange, and it has been created in order to, in an effort actually, to identify the market sentiment, okay? Something that I missed adding to my sorry, to the slides are the creators and etc. of the VIX index, but so let me just okay. Let me just trying to present you also a bit of the origin of VIX. So okay, no, I can't. Okay, nevertheless, I will speak about it. So, as I said, it has been created by CBOE, Chicago Board Option Exchange, and actually. It was initially the origins. I mean, the origin of VIX to the financial economics. It comes from a research of Hanech Brenner and Dan Galai. Okay, so these two people back in the 1989 are the ones that they propose the creation of an asset, an index, okay, that it will capture the volatility, that will capture and present the stock market volatility. Okay, that was they wanted to create something that will present the volatility of the market, and they named it initially Sigma Index. Okay, so um, that was initially the very first introduction by Brenner and Galai for the volatility index. Both of them were actually financial analysts. Okay, in the U.S. in New York University, more precisely, teaching. Teaching actually global finance, the science of global finance. So um, they were the ones initially proposed the volatility index. Um, and actually later on, it was Bob Whaley. Just okay, I know it's a bit very detailed, but I will just finish with it very soon. Uh, Around three years afterwards, I think it was Bob Whaley that actually managed to do this index. In reality, I mean, to calculate the values of stock market volatility based on Brenner's and Galai theoretical work. So Whaley was the one that it actually did the not the manual work, but he was the one that transformed the theory into practice. It was the one that identified the formula that could capture that could calculate the values of stock market volatility, and to actually give us the computations that gave actually the computations of VIX levels to the Chicago Board Exchange, and this is how the volatility index was created. But okay, let's stop with the history of it, and let's see what it is actually. So what it is, very simply, very briefly. But I wanted more information reading VIX and how to use it to, of course, audio lost. No, that shouldn't be the case. No. So apart from using this as a guide of, you can actually trade VIX. Yes, of course, you can trade it. You can use it as it's an asset either way. I mean, it is offered um, from us as well, but it's a tradable index as well. The same stands for S&P 500. The same is an asset. It's an instrument in the it's an index, so it can be traded, and this is what we offer over here. You can trade it, but also on top of that, you can actually use it, observe it, in order to identify the potential move of the rest of the equity market, not solely the USA 500. The stronger correlation that the VIX has is the USA 500, but it can be used also for identify the potential direction of the whole equity market, stocks, shares, indices, and etc., especially the US ones. But we're going to see this in a second. Just let's see what it is first of all. So as I was saying, it's a benchmark. Okay, it's a benchmark of that in which we can quantify. Lucas, can you hear me? You mentioned that the audio is lost, but it's not. Maybe you want to check on your side or something. Okay. So as I was saying, it's a benchmark. It's a benchmark to quantify market expectations of volatility. Okay. Um, so think it in order to think it like in a simple way, you need to have in mind that it shows how the VIX is moving. It literally shows what the markets are expecting for the near term. Okay, for the near term, okay, and for the long term depends on which time frame you are, but it clearly presents the expectations that the market have. It has first of all, it has its values are derived from the prices of the USA 500. Okay, so the way it's calculated. I think I have the calculation as well somewhere. Let me just. Yep, here it is. Very complicated. You don't need to know this calculation, of course. It would be good to check it a bit because this will help you comprehend better how the index trades and why it trades with this way. But it's a very, very complex mathematics. You don't need to know about it, but you need to have in mind that the VIX is calculated using the price of USA. USA 500 index option, and um, so that's why there is a strong correlation between VIX and the S&P 500 because they have actually an inverse correlation. If the VIX values increases, then it is likely that the USA 500 it falls. If the VIX value declines, then there is the more the likely the S&P 500 to be either to experience stability or to rise as well. Okay, so the VIX is actually derived from the, as we said, from the values of USA 500. That's why they have this strong correlation. There is this strong correlation between these two indices, and that's why it has been used from many market participants and like big institutional players as well, in order to predict, if I can say that, the move of USA 500. So it is a very, very, very important index in the world, guys, in the trading industry, in the investment industry, pretty much because, okay, we have said that the values are derived by we have said that the price has derived by the USA 500, but this is not the important part. The important part is that the calculation that Whaley has done, the way he created VIX, he has managed to create an index that quantifies measure of market risk and market sentiment. So the investors, the traders' sentiment. So regardless if it derives its value from S&P 500, the most important thing that we need to have in mind for VIX, and in order to, we need to try and understand the VIX, the signals that the VIX is giving us, is because it helps you identify whether there is a very, very high risk in the market, whether there is a lot of positive thinking in the market, positive bias, when there is a very, very negative bias, whether there is a risk on or a risk off conditions in the market. It helps us quantify the market risk and the investors, the market participants' sentiment, either in the trading or investing industry. Okay, this is the key thing. That's why it's not only important that that it calculates, that it measures the S&P 500, the USA 500 volatility. The key thing is that it captures the sentiment, and it also can be used from us as a benchmark for the entire US stock market. But not solely US stock market, also commodities. It has a correlation with commodities as well, and oil. But the strongest thing that you should have in mind is that it can be used as a benchmark for the entire US stocks. So the price of options, okay, is considered a good measure of volatility, as if something concerns the market, the traders, the investors, you guys use as traders. If something concerns the market participants, they tend to start buying options. which causes price to rise. And this is why the VIX is also known as the fear index, because it measures the level of market fear and stress. So the current volatility cannot be known ahead of time. So the VIX is best used in time with historical analysis, support and resistance lines. Are you okay so far? So let's move on. Let's move on to the perfect. Yes, okay. Thanks for the confirmation. So I mentioned before. So this is just a screenshot from my platform, from the VIX indicator. This is just a daily chart. It doesn't matter. There's a daily chart, by the way. Just it was just an example, okay? Um, uh, um, yeah, it's just a screenshot, because I would like to highlight. I would like to make sure that you understand what the VIX chart presents, what kind of signals, how you can interpret the VIX values. Okay, so something that we have said initially, I mean, in the intro, but maybe it's a good it's good to show it right now. Okay, here it is. This is the S&P 500 and the VIX indicator together. I mentioned before that there is a strong correlation, negative correlation between the VIX and the stock market in general. Okay, the US stock market in general, but the strongest correlation, as I said, is because is with the USA 500, just because it derives its value from. Okay, that's why there's a very strong indication. So as you can see over here, I have captured VIX and the USA 500, put it in together side by side, just to see, just for you to see this negative correlation that once the VIX is moving up, then the USA 500 tends to fall. Okay, because of what? Is it because of market participants is it because, okay, I will make a question to make sure that you understand that you're with me so far. Let's as we can see over here, VIX in January rallied, okay, that, and we said that if the VIX moves up, S&P 100 tends to fall, right? And this is indeed what happened. But from what this shows in regards to the current sentiment in the market, does it show that there is no fear, or does it show that there is an increase in fear? Anyone? Just whatever comes to your mind, whatever you think. No one? That's fear. Yes. This is when there is a spike in VIX, is an increase in fear. Okay, so think about it. When we have an increase in fear, then we can see safe havens moving. We can see dollar, the safety of dollar sometimes to increase as well, because it's the safety of dollar, etc. So it's correlated with the with the we have a um, we have an increase in fear, so that affects also the safe havens, the risk related assets as well, other than the USA 500. Shaik, this is not the trading view, this is our own platform. So as you can find in our website, we are providing the volatility index for the derived from the SP 500 index options. I don't know what TradingView has, but we this is the MT4. This is our what we offer. So cannot really tell what the TradingView is offering. Yes. Okay. Yes, Babidel. That might be right as well. Yen also increases. Yeah, it has to do with the risk on and risk off sentiment. So you can identify in which condition the market is whether it's in risk on or risk off condition based on whether the VIX is rallying or declining. So if it's to the upside, that means that um, um, sorry. Sorry for that. Um, yeah, it means that fear is increasing, and uh, there is a lot of um, uh, risk appetite. Okay, risk aversion. Sorry. So that's why yen is affected, gold is affected, dollar is affected, dollar index I'm referring, risk sensitive assets such as Aussie dollar as well. It's a risk sensitive asset as well, and Aussie yen, and etc. So on and so forth. Yeah, so let's move on. Where did I left it? Sorry, I missed a bit. So let's get, yeah. So you can see over here that this is the 2022 charts, okay, from the end of 2021, this December, up to date. And you can see that for the current year, we have a very, very strong correlation between these two assets and between VIX and the US equity market in general, stock market in general. So we can see that the spike in January with this big bullish candle in the very beginning of January, okay, in the very first, actually was, I think, in the mid, sorry to be present, in the mid of January, indeed, uh, indeed um, um, uh, uh, signal the sell-off of USA 500 down to until the bottom that was breached at the very end of January. Afterwards, we have seen a bit of a correction, actually a sharp decline of the VIX. So it was, it seems that the markets calmed down a bit. Um, and this is when the equity market started rising as well, the USA 500 and the equity market as well. So, and so on and so forth. So you can see this really, really strong negative correlation. Now, sorry. So we speak about USA 500, but just to clarify something, indeed, once the VIX moves up, like we can see over here, the USA 500 and the US stock equity market in general tends to fall because of the increasing investor fears. But on the flip side, when the volatility index decline, USA 500 and the equity market could uh, found some support, could be boosted, but they could also experience stability. This is because, so either to the upside or sideways stability, because it's when we have a stress-free condition, when the investors calm down a bit. So trading volatility is not the equivalent of a market downtrend, okay? Because it is possible for the market to decline, but volatility to remain low. So when the volatility index declines, we have two scenarios in regards to the US stock market. Because if volatility declines, that means that we have a calm markets, stress-free markets, and etc. So that might imply either to a boost of the US stock markets, but also to a stability, a sideways movements, because the volatility is low. Okay, so remember, volatility is measured. Let me just get back. back to my. Okay, this is the. Okay, I'll come back in a minute, but let me get to the my very first slide. And I would like to highlight that you need to have in mind that volatility is a measure of the movement of an asset price, right? So this means that when you trade volatility, you are not focused on the direction, right? If you're observing your VIX, your volatility index, you don't really, okay, obviously the direction matters as well, but the direction matters if you are using VIX in order to trade US stock markets, the S&P 500, etc. But if you're monitoring your VIX indicator in order to identify the volatility in the market, okay, because you want to trade the volatility in the market, you are not focused on the direction of the VIX. You are focused on how much the market has moved and how frequently movement occurs. So how big these VIX candles are, how frequent. Because you're trying to identify whether the volatility is increasing, is extending, is the volatility is increasing, or whether the volatility is decreasing. Okay, so have this in mind if you are thinking of trading something else based on the on how on what the VIX indicators represent, on whether you have identified a very stress-free condition, or a very or a fear condition, and etc. Do you get what I mean? So now I have highlighted over here the tops and the bottoms. Why is that? Just to okay, so why? So these tops and bottoms of the VIX, they help to also spot, to predict, if you prefer, the tops and bottom of the USA 500 as well. So the higher the volatility index gets, the extreme it gets, okay, this is a sign of bullish or bearish pressure on the S&P 500. So what I'm trying to say, if if the VIX breach to extreme highs, maybe you can use your Bollinger Bands in order to identify when the condition is overbought or not. But if it reaches extreme highs, this is a sign. And I think I put it on the very next slide, didn't I? No. Come on. Oops. Give me a second. Do I have it anywhere? No, I don't. Okay. As I was saying, okay. If the VIX it reached to an extreme high, okay, an overbought condition, a peak, then this is a sign of an embedding bullish pressure on the USA 500. If it reaches extreme lows, okay, it is seen as a bearish sign for the USA 500. Okay, remember, this is, I put this mantra later on. Oops. Sorry, I've messed a bit my. Where's the rest? Okay, yeah, here it is. This is something you should have in mind, that as a mantra in order to remember what the VIX is present and what is not. So the VIX, when the VIX is high, there is a mantra, actually, an old mantra that exists since 1992, when the VIX was initially invented. That it says that when the VIX is high, it's time to buy. When the VIX is low, look out below. Okay. This is just a matter, maybe it's an easier way to remember how to what useful information to understand the VIX values and etc. So like every other in the index, when you trade the VIX, you aren't trading an asset directly, because there is you can actually, obviously you can trade the asset directly in our MT4, but if you don't want to trade the asset directly, but instead you want to understand the market condition, the market volatility, in order to either take your positions in the stock market or in the forex industry or in the commodity market, etc. Um, then then you can use it as a volatility indicator, as I already mentioned. So you can use it. So let's get back to the MT4. Okay, here is our VIX. So you can use the you can use CFDs in order to take position on the movement of the VIX. Okay, so you can use it either to trade, as I said, US stocks, right, shares, US equities, or ETFs that they are correlated with the USA 500. Okay. So what else I wanted to mention at this point? Okay, so let's move on. Let's get back to our slides. Let me get back. The correlation again. Don't worry, Dennis. Anyway, we're gonna see the correlation once again in the next few slides. Okay. We have seen the calculation. So yeah, something that just to highlight this very last bit as well that I used. I mentioned I have a bullet point over here. It says that puts down, calls up in the option market. So what that's supposed to mean? So okay, come on. I haven't said my. Okay, here we are. Okay, over here. So the basic theory, if I can say that, yeah, basic theory. The basic theory behind the VIX and the calculation of the VIX is that because it's using the USA 500 pounds, okay? So the basic theory states that by combining the weighted prices of multiple USA 500 put and call options over a wide range of prices, we can gain insights into what prices traders are willing to buy and sell, right? The USA 500. That's why, as I have put on in my slides earlier, a call option will give you right to buy the USA 500 at a specific price, while a put option will give you the right to sell at the S&P 500 at a specific price. So this is why I've put this on. If the if we we can actually with a call option we can buy the USA 500, while with a pure put option we could sell the USA 500 based on the up and down respectively of the VIX indicator. So I went too much in the detail, but this is essential in order to understand. That's why also this okay, so if you have any questions, just let me know, okay? Just let me know now before we move on. Okay, so no further, no questions. Okay, so let's move on. Something that I haven't mentioned, a bit of a topic you are I'm not sure whether I can tell. No, I'm not. Depends. The long term, yes. Sometimes I like to check in the long term my charts, like without any indicators on, but indicators help me, give me confidence, to be honest. But it's up on each one of you guys to figure out whether you are a price action trader or you prefer technicals as well, prefer the technical indicators as well. But there's nothing wrong, I mean, with price action trader, like naked charts, solely price action. Okay, so I'm not really sure whether I can tell what I am. Okay. Yeah. So, yeah. Just to explain a bit more what I mentioned earlier about call options and put options. So, exactly because of all the things that we have just mentioned, okay, um, we can see very, very often, especially from big players, from institutional players, and etc. The VIX, this volatility index, in general, the volatility instruments, uh, to be used not solely for identifying the volatility of the market, whether we are in a risk on, risk off mode, or to figure out how they could trade the USA 500, in general, the US equity market. It is very often used to hedge. Many market participants are looking the VIX, the volatility index, in order to hedge their portfolios. Okay, so just to clarify, what is a hedge? A hedge is when, with intention of reducing the risk, we're making we are doing an investment that is made with the intention of reducing the risk of adverse price movement in an asset. Okay, so when um, hedging, when we proceed with hedge, is it means that we are having an offsetting or opposite position in a related security in order to minimize the risk. Okay, and this is something that we can see very often from many market participants, big ones or small ones, and they using actually the VIX indicator and the volatility indicator for hedging their portfolio, as I already mentioned. And that's why okay, so if they want, if the investors, for example, usually the long-term ones. But if for example the investors want to place some positions in the equity market volatility, um, they they sometimes use them to as hedges. So for example, the VIX related ETFs with other related products, maybe USA 500 as well. So we can see this kind of hedging many times more precisely with VIX. So by taking, for example, because of the thing that we have just discussed, because the VIX, it has a strong negative correlation with the stock market, all the assets, all the instruments that they are VIX related, okay, um, are are very popular choice um, for diversification and hedging in the market. Okay, and by referring to VIX linked instruments, uh, I'm referring to maybe ETFs that they are that they are US say 500 related. They are using USA 500 related. They are composed with companies that are in the USA 500 as well. In general, uh, sorry, let me try to find some examples for you. So if you log into our, so okay, here is our website. For example, a VIX linked instrument, okay, is over here, okay, and where is it? Here we are, you see. So here we have an ETF, USA 500 ETF. Obviously, it's an ETF based on the USA 500 stocks. So this is a VIX linked instrument. So that's one example. So as I was saying, because of VIX strong negative correlation with the stock market, it's very common from market participants to use VIX related assets for diversification of their portfolio or for hedging. So by taking, for example, a position on the VIX, okay, by trading VIX, by taking a position on the actual VIX, okay, uh, you could potentially balance out other stock positions in your portfolio and to hedge your market exposure. So let's assume, I'm not sure whether I have, yeah, I do have. So with this way, by the way, by hedging your portfolio, you can manage the falls in your equity portfolio. So if you have if you have open positions in some stocks and things turn out the wrong way, okay, so by hedging with the VIX, you can manage to limit your losses, and with this way you are limiting your risk. So the value of your portfolio falls, okay, because something happened and your investment in the equity market didn't went as you were expected, but you decided to hedge your portfolio, and so the value of your portfolio falls, for example, you can still make a profit based on the rise in volatility. So you can use the VIX, you can trade the VIX with an opposite position in order to minimize your risk, but also end up with profit instead. So uh, this you can achieve that by setting call options on the VIX if your equity portfolio or your equity positions are losing in general. Okay, so this is the way it can be used as for hedging. Now, yeah, we have seen that. But let's can you see over here? Here you can see in reality. Okay, this is a long term. This is since 2012. It's just to show you how strong the correlation is between VIX and USA 500. But in general, how strong the VIX is, the strong negative correlation is between VIX and the USA stock market in general. So every spike of VIX meant a decline of stock market. Every drift of VIX meant a rise in the equity market. Okay. So, and we have sharp rallies and sharp drifts in VIX. That's why it's quite easy to identify how the US equity market is about to move. So let's say that you have, for example, a long position. I'm getting back to the hedging thing. So let's assume that you have a long position. Actually, let's get the MT4 back, and let's assume that, I don't know, Amazon. Let's see Amazon. Let's see that you have a long position in Amazon. Okay, it's a US company. It's a constitute of the USA 500, right? So let's assume that you have a long position. Although you believe it has a long-term prospect, so it's okay. Although you believe that it will, the long term will move up, you want to reduce your exposure, okay, to some short-term volatility. So you're getting back to the VIX. Okay, it's not a great example, but I'm trying to make you understand. So you go back to the VIX and you can open a vice versa position, so a buying position, okay, on the VIX, with the expectation that the volatility is going to increase. So by doing so, you might balance out these positions. So a long position, long-term position in Amazon in this case, okay, okay, which is currently not a big good example because it's falling, but okay, let's do vice versa. So it's in a drift, right? So sharp drift, and you think this is an extreme condition, so you decide in the long term for the rest of the year, this could be a buying the dip opportunity, for example. In order to minimize your risk, you can use VIX, as I said, by placing an opposite position, so selling the VIX, for example, with the expectation that the volatility will calm down, will decrease. Because currently volatility is in a spike, as you can already see, it's to the upside. So this is the way that you might consider balancing out your position, reducing your risk. So if you're wrong that Amazon eventually will move up in the long term, by the end of the year, for example, it will manage to recover and we're gonna get back to where it was initially. Okay, if you end up, even if you end up wrong, okay, um, and Amazon, for example, doesn't recover, and the volatility on the flip side doesn't decline, doesn't decrease, your losses to your VIX position could be mitigated by sorry your losses to your VIX position could be mitigated by gains to your existing trade. So by hedging, you can, as you understand, you can mitigate any losses that you might had by your initial position um, in the Amazon stock, for example. Are you okay so far, guys? Have you got it? Are you okay? Have to leave with catch the rest? Yes, sure, Gray, no problem. Are we okay so far, guys? Yes, perfect. This is okay. So what we have over here, this is just an example that I managed to find. Okay, it's an old one, but we have in this screen we have the 2-hour chart for USA 500, Dow Jones, Nasdaq, DAX, VIX, which is this one at the very bottom, FTSE, Korean stock price index, and band, EU band as well. So you can see that we have US stocks indices, sorry, European indices, the British one, the FTSE, and Korean as well. So the reason why I put this on is because I wanted to clarify and to make you understand that even though the strongest correlation is with the USA 500, it doesn't mean that you cannot use VIX for the rest of the equity market, even the European one, even um, um, the the Asian one, and etc. Because it's a volatility index for the whole market. It presents risk, fear, and greed, right? Remember, risk on and risk on mode for the whole market. So as you can see, okay, let me zoom in over here. This is the VIX, if you can see it. I send you also the link to, I don't, okay, never mind. You can see this is the VIX over here. So you can see that we have put two lines on the 20 round number and 21 another round number. So it was right moving sideways above the 21 until it broke it down and moved below the both support levels, deep down to the 18 level, rebounded, okay, found some struggle a bit to break the 20 level, but eventually at this very last candle, can you see this very last candle? It's has been hovering around the 20 and 21 level. Okay, that's very last candle, 4-hour candle. So the VIX has been, remember that it has been a great shepherd for testing whether the stocks will rise or fall. Okay, remember we initially said that is a barometer of the risk. So the fact that is it gapped up first of all, and is quite dodgy, is sideways, like in the middle of this range, small body candle. Um, gives us an indication, actually doesn't give us any indication, it's something that we should add in our monitor list, because we need to identify whether it will manage to move above 21 or whether it will eventually ends up again below 20. So this, if the asset, since there is an indecision over here, even though it gapped up, which means that it rallies, so we might see a fall of the equity markets. However, a breakout above 21, it will signal that the equities globally, so DAX, Nasdaq, FTSE, Euro, etc., could keep falling because they are already in a fall. You see, this is the 4-hour one, VIX, and we have used the 2-hour ones for the rest of the 2-hour time frame for the rest of the equities. We can see that are in a fall, or some sideways movement, but overall in a fall, in a dip. The same stands for FTSE. It was the only one that it bounced temporarily, but we had a big decline in the very last 2-hour candle, coinciding with the picture that we're getting from the VIX right now. So if we see more VIX breaking the 21, which was a very strong support level, so now has changed into a very strong resistance level that will imply to the equity markets to fall further. If we see the VIX turning back down again below 20, that could sign a rebound, maybe temporarily one, but a rebound of the equity markets. Okay, so it doesn't matter. It is not used solely for identifying for identifying an entry level or a direction of the USA 500, but for the whole equity market. Let's move on. So we have covered all this. I mean, over here, this slide's it's about how to use VIX, but we have already mentioned that. So the thing that you need to have in mind that it doesn't matter which trading approach you are using. You can use your style, your trading strategy in VIX as well. But what you need to have in mind is that it's an index, okay? It's an index, so it's trending or is ranging like every other index and asset that we have in the market. So you can use any trading approach you want. Use the one that you are using for the rest of the assets as well. The only thing that you need to be careful about is that because it's the most volatile index of all, you can use it as it's a good indicator for risk management. So you can use it for risk management. It's quite important in with the way that we have just presented, either by hedging or identifying whether there is a risk on or risk off mode in the markets. Also, it can be used. It has also an impact on other markets such as forex, commodities, spots, and futures, and is very closely aligned with FTSE. So that's why, let's take a step backwards. We can see, we can see that this sharp that if we compare all the rest of the indices, FTSE, it was the one that it was affected the most on this gapped up. On this gapped up, the one that it had the biggest move, it was FTSE. Is because it is closely aligned with the VIX movements too. It's a great sentiment indicator used by all the major market movers and portfolio managers to manage risk. As we already said, that there is a type over here, I need to fix it. And I will, okay, before we move on to the very last slides, I would like to touch a bit this thing because I mentioned that it also has an impact on the commodity market, spot, futures, forex, etc. And this is an example. So here is my VIX on the bottom left side. Obviously, we have discussed about you say 100 stocks as well. Can you see how this is the April and May this year? It's a current screenshot. Actually, a screenshot that I have taken today, so you can see as VIX moves higher, S&P is down, Amazon down, Google is down, and so on and so forth. But what happens with what happens with other assets such as gold, silver, oil? So at this point, I need to highlight that it has been proven that let me just have it. Come on, sorry. Let me just okay. Trying to zoom in a bit so you can see the movements of gold as well. Come on. Give me a second, guys. Sorry. My bad. Okay. So as I was saying, there are studies, and over the year it has been proven that there is correlation with the commodities, with oil, gold, and silver, for example, as well. Not as strong as the USA 500 is, but it has been identified that there is a correlation. So I think I have also the link on, so I can share with you the link of this study. Let me share with you the link, so you might, your free time, you might want to have a look at it. Come on. Let me find it for you. Come on. Give me a second. Yeah, here it is. Okay, I will share it with everyone in the chat room over here. So this is the research that I'm talking about. Okay, so this paper actually took data from 1990 up to 2010. Okay, and they have tried to find any correlation. So they find out correlation with three commodity futures, so gold, silver, and oil. So with gold, okay, here I have gold at the very bottom, silver is over here, and oil is at the top. So they have found out that gold and silver have a positive relationship with volatility. Remember, gold is a safe haven as well. So a positive relationship has been identified with volatility index. Okay, and this is this research actually indeed supports once again the idea that investors, market participants, perceive precious metals as a safe havens, and they purchase safe havens in anticipation of rising equity market volatility. While on the flip side, oil, with oil, they have identified actually the researchers based on this paper, that there is a negative relationship with implied volatility, and that indicates a reaction to an anticipated decrease in demand. So, um, so, based on this research, we can see that the volatility has little or no influence on the returns of oil, for example. Okay, but it does have an impact on the precious metals such as gold and silver. Okay, so that's why commodities are also used, are very important actually for expanding, for portfolio diversification, used as portfolio diversification tool, the same stands as for VIX as well. Okay, now let's get back and finish with my very last slides, which I don't really have anything. It's not like something new, but it's just comparison, just to show you that just to show you why VIX is so important and what a historically high VIX means for stocks. Okay, especially the last with the COVID, we have seen the past 2 years historically high VIX levels, right? So if I just put the weekly chart on, okay, cannot get back. We have seen like big spikes and big rallies in VIX as well. So this is this is research has been made by Rocky White, which shows how significant strong rallies in VIX are for stocks, and this takes us back to 1998 up to date. Okay, so what these two tables present. Okay, so here we have a table since 1998 for both VIX and USA 500, and there is a comparison. So is how much the VIX appreciated from the 21 days high value, okay, the VIX value, okay, and um, also in the very last column we can see how many points higher it moved. And what else? Yeah, so how much it appreciate percentage wise, how much it moved away from the 20-day average as well, and etc. So that's VIX. On the flip side, we have actually not we, Mr. White, recorded the same days where USA 500 was. Okay, whether it drifted lower, actually how much it detected or appreciated, how much it moved either to the upside or to the downside for 2 weeks, a month, 3 months, and 6 months, and etc. Okay, so over here we have the performance on the flip side for the same days. He recorded the performance of the USA 500. And the return, whether the return was in loss or in profit, whether it was up or down. So as you can see, the bad news is one time it was in for once actually. Let's get to the crisis of 2018. That's why we have put with bold as well. It was the date that for actually after a decade you can see the biggest drifts, the biggest decline in USA 500. So that was that back then the market, as you can see over here with this bolt, it was the one the market drift as by 15% just in 2 weeks. Okay, it was a massive decline. You can say, but Andrea, we have seen worse. Yes, we have seen worse now in 2022. And that's why we correlate 2022 and the last 2 years since the pandemic started as one of the worst, as even worse than the 2008 in which we had the global crisis. But the only reason I'm presenting this is because I wanted to understand that VIX can be used as a key indicator. Why is that? You can see that. Okay, I will take you back. And over here, first of all, we had 26th of March, we had the VIX appreciated by 97%. So it spiked to 61 level. Okay. And let's see what happened in 2020 to the stock market. After we have spot that the VIX appreciated by 91%. So we can see that okay, this is in 1998, but actually I will bring it back to you. So on the 26th of March, sorry, the first time that I'm doing this webinar, so that's why I'm struggling a bit. I should have put more wording on, so that will help you as well. But let me get to 26th of March, so like 2020. So let's get back to our. Oops, I want my MT4. Where is my MT4? Okay, where's here? It is 2022. Let's get back to 2022. Ah, God, I don't have 2020 this year. Okay. Never mind. Let's get back here. So we can see in this table a summary of USA 500 trends after we noted the above, which the above is, come on, this. Okay, so the table over here, this one, which takes us back to 1998, it shows that the returns since 1998, right? So this is the returns of the USA 500 since 1998. So the year of the first signal. So it's only 7 data points, but stocks have struggled in the short term with 2-week returns averaging at 2.46% loss and only 3 positive returns out of 7. So out of 7, we have 3 positive returns. That's a tiny one. And we could say that is 2 positive returns because this is nearly 0. So the 3-month return, however, was promising average a return of 5%. Okay, 5%. And let's get back to the VIX. And it was when the VIX appreciated by 43%. So you can see, and actually I could do that. Can I? No, I can't. Come on. Okay, let's do that in practice. Let's finish with the actual numbers. So here we have VIX, okay? Let's in a weekly chart. Let's measure, okay, here was a peak, February. Quite dodgy candle, but a big one. So if we measure the top and the bottom, okay, it was around 82 pips. 82 pips. So let me do it percentage-wise. So 36.2 was the high. It closed. It actually the low it was 21. That's so 8 pips movement. So that was a 22% decline if I have done the math correctly. Yes, 22% decline. Okay, so that was on the 6th of March, the week starting the beginning of March. The next week, an even more massive decline. So let's measure that one as well. Another 22. So as a whole, we had a 44% decline, if I'm not mistaken. Let me do the maths as well. So from the 37 high down to, it closed to, sorry for that. It closed down. So from the 36 high, it closed down in a 2 weeks that it declined to 25 level. So that's a more than 30% decline in 2 weeks. That's more than okay. And let's go to Amazon, for example, or I don't know. Yeah, let's go to Amazon and let's see. Okay, actually, let's be precise. Let's put the daily chart as well. So in VIX, we have spotted a decline on the 8th of March. By the 18th of March, we had a 30% decline. And let's see what happened to Amazon back then. So we said 8th, wasn't it? 8th? Was it 8th? Let me just compare. 8th to 18th. 8th, it was the bottom of the decline for Amazon. And up until 18, it started rising. It was already in a rise. So if you have spotted this decline, okay, even very late, even if you spotted this decline on the 18th, even if you have spotted it very, very late, you can see that there is still room to the upside. Can you understand now how important it is to identify the volatility of the VIX, how the VIX is moving in order to trade the rest of the market. And if I put gold as well, so let's find 8th. On the 8th, it was a peak. So a decline, remember, positively correlated. With gold, they are positive correlated. So this decline happened at the same time with a gold decline. Are you okay so far, guys? Because I'm running out of steam. I will end the session. So we can see inverse correlation and a very good indicator for trading to the upside, Amazon, for example, and the US indices, and for trading with a positive correlation, the gold. So as soon as we saw this reversal, we could enter short on gold as well. And we can time this exit as well, okay? Because the VIX started consolidating and moving weaker. I mean, small body candles after the 18th. So, okay, it started bottoming. So somewhere here on the 29th, we had a floor. So this is when we could exit gold because they move aligned. They move on the same direction. So if you don't have any further questions, I will call it a date. And I will wait for your questions maybe in the webinars at hotforex.com in the email address. But that was pretty much from me in regards to the volatility index, correlation between the stock markets, the correlation between safe havens, oil, gold, silver, and or its purpose as a volatility index in general to spot the index. So if there are no further questions, I will call it a date. Thank you very much for participating, guys. Hopefully you find this webinar useful. And if not, if you're struggling with it, let me know. Send me a screenshot at webinar@hotforex.com and I will try to reply ASAP. Okay? Okay, I cannot see any further questions, so I'll call it a date. Thank you very much. Have a great day ahead. And see you again on a Facebook and a YouTube live maybe, okay? We're gonna have one today after, right now actually, story is gonna go live, and on Friday as well. Thank you very much. Have a great day ahead. Bye-bye.